first question of today is, when should you roll over your 401k to an IRA or another 401k? I think that's the big topic of today. In essence, after watching this show, you should be able to essentially capture the necessary information of when you should roll it over into, a new 401k or an IRA. I think there's different types of benefits and pros and cons, and we're going to go through them. There's other topics that we'll go through in a second. So this is the Beyond Return Show. It's a forum about business, markets, financial planning, and more. We are here, as usual, with Montebello Avenue founder Robinson Crawford. Robinson is a certified financial planner who serves over 50 clients locally and throughout the country. I'm hoping I'm going to edit that number in the next episode to go up and up. My name is Gabriel Kaplan. I'm the founder of Wealth Habits and Strategic Investors. I'm a financial advisor, and I help people invest and manage their portfolios. Given my background as a CPA, I also help people figure out strategies to optimize their taxes. And that's something we are going to talk about today because it's the end of the year and taxes are a big theme with our clients. So just before we start, just to note that this is educational information only. And for some people, this is entertainment. So I just want to keep that clear. Like, if there's anything here that there are takeaways for you, please consult with your own tax or financial advisor or attorney. So what's on the agenda for today? Should you roll over your 401k if you change jobs?
There's a few background questions that you have to answer before you're even able to consider whether this is something that you should be doing. So the main advantage that I think about with this is if you choose to consolidate, if you choose to roll together, you have the advantage of not having to manage a set of investments across multiple accounts, which if you've ever managed a portfolio or had multiple accounts, you'll know that the more accounts you have, the more decisions you have to make, the more you have to allocate between them. So it is simpler to have one account than two accounts. That's my first basis here.
But let's backtrack a little bit. I think there's a couple of options, like higher level options that you can do, right? So when you switch jobs, you had the opportunity first to roll over the account if you want, right, to an IRA. But the other option is you could leave it there if you want, right, at the old 401k. And I think the third option is you roll it over to your new 401k where you switch jobs to. My question is, when should you actually leave it? Like, when would be a good option? Just say, hey, I'm not going to bother to rolling it over to an IRA, or just to roll it over to the new 401k.
You have evaluated the investments and the investment options that are inside of the plan in which you're leaving it, and you like that. Possibly you have different tax treatment of different accounts. So maybe you've contributed some to the Roth 401k account and some to the traditional, and then your employer matched some. So you have some different buckets within that 401k, and you're not interested in dividing those up and sending those to different places. The Roth component adds some different wrinkles here. You're not getting kicked out of the plan, so the employer probably needs to still stay in business and needs to keep sponsoring the plan, right? So if you leave a job and then they go out of business, generally that doesn't mean your 401k is unsafe. You can comment on that. I haven't seen that be an issue with old 401ks becoming like a liability of a bankrupt company or anything like that. But the plan has to stay open. You need to like the investments, you need to like what you own, and they need to allow you to stay there, right? You can't get kicked out.
Yeah, I would say there's one specific case where I've seen this pop up pretty often. It's when my current, or like the person's old 401k has really good investments, so probably like Vanguard or whatever low cost index funds that are. It's more common to see those plans now, but in some places those plans don't exist, or those options don't exist. And the other, in that combined with people who want to do backdoor Roth IRAs, right? So they don't want to contribute that amount to the IRA because that would be more difficult to do the backdoor Roth IRA, because you have to. There's a separate calculation there, a pro forma calculation that needs to be done at the end of the year. and at the same time, your new employer's 401k, it doesn't have the best option. So then people tend to leave money in their old 401k. But other than that, um, there's another case though. Almost forgot. It's if you're retiring early and you need access to capital. Not 100% sure, but I do believe that you can take out money from your 401k earlier than your IRA. Is that correct? Without the 10% penalty.
This only applies actually if you're over age 55 and considering a rollover. But if you are over age 55 and considering a rollover, you can withdraw. You basically get a break on that age 59 and a half requirement where you need to be 59 and a half to withdraw money penalty free from a 401k. So if you are 56, you leave your employer, it doesn't matter what you do after, you are then able to withdraw penalty free from your old employer's 401k. It's called the rule of 55. So that is one slight benefit where you would be happy to have left it with your old employer rather than roll to an IRA or roll to your new employer.
What's the penalty for the IRA if you take money out before 59 and a half?
That is 10% on top of income tax. So
essentially, you pay income tax, because it's pre-tax money, obviously, right? And then on top of that, it's a 10% penalty.
Correct.
And the second option is you roll your old 401k into your current 401k. I mean, I think we discussed it in the previous case. It's just in this case, maybe the better options are in the new firm, and you still want to do that backdoor Roth IRA, so you don't want to have a big balance at the end of the year of an IRA, and you don't want to have to do a large taxable conversion.
I have one more special, interesting case for you where it's possible that you wouldn't want to do this.
I'm all ears.
Yes. So let's say you worked for a while for another employer. You were a W-2 employee and you built up a substantial 401k balance at your old employer. You leave to start a new venture, a business yourself, and you want to sponsor a 401k for yourself and maybe 2 new employees in your new small company. If you roll in your old 401k balance to your new company's 401k, you immediately have what's called a top-heavy plan, where the owner owns a lot of the plan assets as a percentage of everything that's in there. And without going into too much detail, that could potentially be problematic and is something you want to consider before you make that choice if you're sponsoring your own 401k plan.
We should actually have another show about 401k plans specifically for small business owners. That'll be in the works from a couple of months. And the other consideration, let's think about the benefits of rolling the funds from your old 401k into a new IRA. I think you said it so well previously. It's like you have way more investment options, potentially lower fees because you're not paying for the plan costs, and the ability to potentially consolidate funds. Is there anything else that comes to mind?
IRAs are subject to a different set of rules in general. I would say that one thing that I try to bring up when this is a topic of conversation is that this depends on your state, and it's really an attorney who should answer this question. But if you're thinking broadly about asset protection, which is, of course, a separate show unto itself, separate topic entirely, 401ks often have better credit protection. I know you asked for pro IRA considerations, but this is a pro 401k one. If you are in a fender bender and someone tries to sue you for everything that you're worth, in most states in the U.S., you're better off having wealth in a 401k than an IRA. That's
news to me.
Not ironclad, not legal advice at all, but is something I've heard from asset protection attorneys.
Sorry, does it depend on the state also?
It does.
Got it. How is it in Arizona?
Arizona, I think IRAs are fairly safe. I believe. I won't
quote you on that.
Yeah, I am literally being quoted on that, but don't quote me on that.
I want to talk about the special deduction in 2020, and that is the charitable deductions. Initially, when the tax cuts got passed, those were essentially not eliminated because charitable deductions still exist, but they became less important because the itemized deduction limit, the standard deduction became so large that you really needed to donate a lot of money in order to start itemizing. But this year, I don't know which act fixed that, but you're allowed to deduct up to $300 of cash charitable deductions on your return, even though you use a standard deduction.
That is nice. That was probably a good thing. I think Giving Tuesday was yesterday. You still have time. I believe it's also you have to make the cash gift in 2020, so before end of year. So if you're looking, there's somewhere you'd like to give a gift to that's a nonprofit, give it in cash, give it in 2020. That has been
save the receipt.
That has been expanded, where it may not have been useful for you the past couple of years. It should be useful this year.
What topic did you bring up?
Yes, this is a hairy one, I know, and one that can cause anxiety in people, but I don't think should be too terrible. I want to talk about two proposals within the Biden tax plan that I think are pretty interesting and are pretty radical. The first one, which I'm still getting my head around, just how much this will change the planning work that I do for clients and the way that I think about retirement contributions, is that there has been floated a proposal to eliminate the nature in which we deduct retirement contributions, eliminate the deduction for that, and replace it with a flat credit for actually having done the deduction. It basically means that instead of retirement contributions being more valuable the more money you make and the higher tax bracket you're in, it's going to be more equalized in terms of the relative value to each taxpayer, rather than a deduction, a credit.
So essentially, they want to take out the benefit for making a lot of money and contributing to a retirement plan. Essentially, they're just going to tell you like, oh, if you made extra money, then you still get the same credit as if you made less money.
That's right. So it's sort of flattening the benefit. From top earners get the most benefit right now from retirement contributions, meaning the highest percentage deduction. The lowest earners get the least benefit. This is trying to flatten that benefit. Is that a fair assessment?
Yeah, it is. I mean, I think we're always going in the way of taking out those special benefits, specifically when they relate to the high income earners. They're just going to get slowly eroded, those special benefits, and they're going to find ways of really trying to come up with justifiable ways of doing it. It just complicates the tax code so much by doing this. But
it only gets thicker every year.
Yeah. Do you know what is this? The rate that the credit will be? It's equivalent
26%.
So essentially, but my question is, if you are in a lower tax bracket than 26%, do you get that 26%? So do you get more credit, or is it up to 26%?
I think it's flat. I believe that you get a flat 26% credit. So if you contribute $5,000 to a retirement account, you then get 26% of that off of your tax bill.
Oh, that's interesting. So you could technically, if your effective tax rate is like, I don't know, 20%, you're getting
a boost,
a benefit for contributing. That actually is a nice sidekick there. Of course, if you're in the 39% tax bracket or future 39% tax bracket, then you don't.
That's tough.
You lose out. Yeah,
you do. But in that way, in the framing that you just made it sounds a little bit like a government employer match, right? It functions that way. It
does.
Yeah, it's like the government is giving you a little match on your retirement contributions. There's one more that I wanted to bring up that's pretty dramatic, and it makes me think. It makes me just giggle a little bit politically. This feels like a shot at the outgoing administration, but there's been a proposal to eliminate two amazing features of real estate investment for families and legacy. One is the 1031 exchange, with which, if you're not familiar, is basically a way to sell old real estate that's appreciated significantly, buy new real estate in a short period of time, and not pay the capital gains in the meantime. It's
as long as that real estate you're buying is of greater value than the one you sell, right? Equal or greater value.
yes. There's a lot that has to go into it. Operationally, it's got to happen in a specific time frame. Consult a lawyer to get it done correctly. But 1031 exchanges are extremely popular. Have kept a lot of real estate investors from paying a lot of tax on appreciated property over the years. The outgoing administration's family, I assure you, has benefited terrifically from this part of the tax code. So they're talking about eliminating that for people with incomes over $1 million, I believe. The other one is what's called step up in basis at death, which means that if, let's say,
this is a big one. I think this one will really affect business owners and farm owners, anybody who has a considerable amount of assets and they're operating. It could be operating assets, it could be whatever, but taking away that benefit will be it could be a death blow really to some small business owners.
It could, and it's also seemingly, depending how it's applied, it can be seemingly like very tough. So let's say that you have a family home that your parents bought in the 60s for $30,000 and it's worth $500,000 now, and your parents pass away. What this means is, so there's two things in here. One is that death is a realization event, meaning death, like passing away, is the same as your assets actually being sold. And then no step up in basis means that all that gain, so they paid $30,000, you probably don't have the record of that from the 60s. You definitely don't have the record of all the costs of renovation that would otherwise, lower your tax bill on this. And then your parents pass away and you all of a sudden owe taxes, your heirs owe taxes on whatever $400,000 of gain that creates a forced sale maybe of the house. There's a lot of implications in there that are quite punitive, put it that way.
I think this really hurts. I mean, think about the farmers, right? They earn pennies on they're barely breaking even with all the tough things that happened in the last couple of years for them. Then imagine someone passes away and the farm goes to their heirs. Farmland is worth a lot, but it doesn't generate much, so you end up having to pay a ton of taxes on the increase in value, and then just forces that smaller farmer to sell to the bigger corporation. It's really I think this is a really big punishment to the small business owner as opposed to a large corporation that never dies.
That's true. Yeah, the big ones don't die. If this stuff comes to pass and we see a dramatic tax legislation change, the value of smart and forward-thinking advice for small business owners cannot be overstated. There are a lot of pickles that you can find yourself in that didn't exist before.
If these changes to the tax code happen, I can assure you this new tax act will be called the Full Employment Act of Lawyers and Estate Planners.
Yes, it's working very hard to get them back to work. Their phones were not ringing enough during the coronavirus crisis. So I
do think, though, changes in real estate, that it does need to happen, because real estate has been like the place where all like the special favoritism has gone in the last like 20 years or something. 1031 has been one of them. That exchange that's unheard of. How invest money, take it out, put it somewhere else, tax free, invest. That's not really fair. At some point, you should pay your taxes on the accrued gain that you've accumulated,
especially for income producing assets.
Yeah. Well, I guess you pay taxes on the income you generate over the course of the years. Actually, not, because the depreciation will eliminate a lot of that stuff. So yeah, they get all the benefits.
Yeah, there's a lot embedded inside of ownership of real estate over generations.
I will say, though, there's one thing that people don't realize, because living in the U.S., you're used to the U.S. system and everything, and because the U.S. has had low inflation for decades now, this isn't really a big issue. But in other countries, there's this thing called adjustment of basis, and so because they've had higher inflation, right? So when people, let's say, buy a property for $10,000 and the inflation just pushes the value up in a couple of years to $100,000, even though there's increase in value there on a real basis, like on an inflation adjusted basis, there might not have been an increase in value. And so what the government does is it allows all assets held under certain people's names increase in basis. And so when you sell it, you're not doing the calculation of 100 minus 10, you're doing 100 minus 10 plus the adjusted basis over the years for the inflation. And that's when you pay taxes on the true economic gain and not on inflation. Because you don't control inflation. The government kind of controls inflation with monetary policy and all this stuff. So if they really wanted to push things, to beyond the line, they could do policies that increase inflation, and you're paying taxes on it. That's not really fair.
That's very interesting.
Other countries have dealt with this in another way. And I actually like it, the idea of adjusting for basis, because then you don't have to have separate tax rates for capital and labor.
I see. Which is what we have right now in a big way.
We have, and that's a huge component of the tax code is like, don't abuse of this rule of like, don't convert the government doesn't want your labor income to be converted into capital at a lower rate. Right. So that's like the kind of, what is that? Is that what the private equities do?
Carried interest.
Carried interest. That would go away because you would need for it, and you take away that loophole.
So in your example, or where you've seen this, is this apply to all sorts of economic investments? So if you buy a stock on the stock market, does that count? Is it just real estate or businesses, everything?
Real estate, any sort of assets that's on the books, you record the basis of what you bought it for, right? Which is the amount of money you paid money for it. And then every year, the government will give you that interest that it goes up for, and you just have to re-record it, right? You record and they could check, because they have your tax returns from last year, and they will apply the rate also, so they can double check that if you're calculating that correctly.
Interesting. So it's also in a way a different record keeping scheme, where in the U.S. I've seen this many times where someone inherits a stock that grandma held forever, right? She bought it in the 70s. No one has any clue what the basis is because those papers are long gone, and the brokerage firm she bought it from is bankrupt and gone. But what you're saying is you would probably be keeping track of unrealized gains.
Yeah, like the broker does it automatically for you already,
mm-hmm.
right? They track basis and they track the proceeds from the sale. So like they're reporting that to the government anyway. So that's very easy. Just the hard part is just making sure you track the basis of all the assets that you've bought, and like that usually appreciate over time. One final thing that we can talk about: Cyber Monday and Black Friday. I think you said offline that you didn't buy anything, that you traveled instead. Where did you go?
We drove to Los Angeles to see my in-laws. California is still newly on lockdown, so going to stores and stuff was not practical. I think my wife actually did do some online shopping, but I personally didn't. That was boring. It didn't make any Black Friday or Cyber Monday purchases.
Yeah, I usually make a list of stuff I want to buy, but it's this time I did not. There is a good website. If you buy a lot of stuff on Amazon, there is a good website called like camel.com. Have you heard of that one?
Yeah, the price tracker. So you can like put in a wish list, and it's gonna track the prices of them like a stock exchange.
Yeah, it does. As you see, and it usually is like certain dates that the price goes down, and you can see really if you're getting the best deal or not. Sometimes you look at these prices and they went up before Black Friday, and then they just went down during Black Friday, but you're still not getting the best price. Kind of unfair.
This dynamic pricing, there's people working on, I think we have our best minds working on like e-commerce pricing instead of sending people to the moon or whatever we were working on in the past. It's now, algorithms to make sure that Amazon gets its profit margins.
Or like a better meme
right.
creator.
Right.
Yeah. So that's all for today. This is for the audience. If you have any questions, please feel free to ask any questions below in the comments. If you like what you've heard so far, please subscribe. It helps us enormously to keep producing content and trying to be helpful.
Yes, and thanks for the support and new subscribers over the past week.
Anyway, thank you very much for being part of the show, and we'll see you next week.
Of course. Adios.